China's property sector has become a major point of concern. Economists are urging Beijing to take immediate action to avoid potential debt shocks. At a recent forum, policy advisors and economists highlighted structural issues. This includes developers' tax burdens and a surplus of unsold homes, which they argue could destabilize the economy if left unaddressed. Now, with the property sector contributing roughly 30% to China's GDP, experts are concerned that inaction may lead to a prolonged economic downturn, similar to Japan's real estate crisis in the 1990s. Among key recommendations, policy experts are calling for a freeze on new property developments to manage supply while shifting financial support from developers to home buyers, especially for affordable housing. They also suggest measures like easing tax collection on developers and adjusting tax incentives to stimulate purchases. China's housing ministry has already pledged to double credit access for whitelisted property projects, aiming to reach 4 trillion yuan by year end. Despite these efforts, housing prices continue to decline in smaller cities, suggesting that current policies may need further adjustments to create lasting market stability. The property sector's struggles have broader implications. Economists warn that strict housing controls could reduce local governments' revenue from land sales, limiting their ability to stimulate economic growth. As demand for housing slows down, some economists suggest that China's central bank considers more flexible interest rate policies to boost domestic spending. Now, with the GDP growth target of around 5% this year, policymakers face the mounting pressure to balance economic growth with long-term stability in the property market, which remains one of China's most significant economic engines. For all the latest news, download the WION app and subscribe to our YouTube channel.